Hello, everybody. This is Ellman, the blue collar investor, welcoming you to this BCI podcast number 72. This one is titled Rolling Covered Call Options on Expiration Friday. We're going to analyze both rolling out as well as rolling out and up. Now, when we write or sell a covered call option, if that stock price is higher than the strike price as expiration is approaching at 4 p.m. Eastern Time on Expiration Friday, and we take no action, our shares will be sold at the strike price. Frequently, we want to retain those shares for our portfolio for the next contract month. So we must buy back the option and then sell the next month's option. This podcast will detail the four choices we have when we are rolling an in-the-money strike. So what is rolling a covered call option on or near expiration? Well, again, it means buying back, or on our broker trading form, it will say buy to close, or BTC, the current short call before 4 p.m. Eastern Time on Expiration Friday, and then selling a new option for the next contract month. Now, this applies to in-the-money expiring strikes, because if the strike is out of the money, there's no need to roll that option. We just allow the option to expire, and then the next week on Monday or Tuesday, we're free to sell another option. Now, on Expiration Friday, we can roll out to the next contract month. That means we're rolling out and we're leaving the same strike that we had in the near month. Or we could roll out and up to a higher strike price in the next contract month. Let's analyze our choices. If the stock still meets our system criteria, and we're talking about from three perspectives: fundamental, earnings and sales growth; technical, a price chart; and common sense principles like minimum trading volume and diversification. Now, the fundamentals are not going to change as long as there was no earnings report, and in the BCI methodology, we always avoid earnings reports. So we know that if we're going to roll the option, that we've come to the conclusion that there was no earnings report both in the current month and the next month. So fundamentals are going to remain the same pretty much. Now, the price chart can't be terrible because the strike is in the money. That means the stock price has either moved higher than the strike or remained above the strike had we sold an in-the-money strike to begin with. And of course, minimum trading volume and things of that nature most likely will not change as well. Now, we do check to make sure there's no upcoming earnings report in the next contract month. We know there's none in the near month because we wouldn't have entered the trade. But we must check to see if it's coming up in the next contract month. We're going to make the assumption now that there is no earnings report in the next contract month, and therefore we can move forward with rolling the option based on the calculations. That's what we're going to be doing now. And we must make sure that those calculations align with our initial time value return goal range. In my case, it's 2 to 4% a month. In my mom's portfolio, it's a little more conservative. I go 1 to 2% a month. So let's look now at some of the rolling out strike possibilities. When we're rolling out we're always rolling out to an in-the-money strike. Why? Because in order to roll out to make sense, the strike must be in the money to begin with. So the moment we roll out, buy back that option, and then immediately sell the next month's same strike, nothing's changed. That strike is still in the money. So we always roll out to an in-the-money strike. So if a stock is trading at 52, and we had sold the near month 50 call, and we're rolling out to the next month's 50 call, well, that 50 call is still in the money in comparison to the current market value of 52. So an example would be we buy back or buy to close the September 50 call and then sell to open or STO the October 50 call. In both cases, the 50 call is in the money, or lower than the current market value of the stock. Now let's set up a hypothetical trade now with BCI initially trading at 78, and we had sold the $80 September call for $2. So we get approximately an initial time value return of about 2.5%. Okay, 2 divided by 78. Now, on expiration Friday in this hypothetical, BCI moved up from 78 all the way up to 86, right? Now, what's the cost to close going to be for that 80 strike as we're approaching 4 p.m. Eastern time on expiration Friday? Well, in this hypothetical, we're going to put 605, which really does make sense. Of that 605, $6 is intrinsic value, the amount that the strike, the 80 strike, is in the money or lower than the current market value of 86. So $6 is intrinsic value. What's left? 5 cents. That is the actual time value, which represents the actual time value cost to close, 5 cents per share. Now we check, make sure there's no upcoming earnings report in the next contract month, and that all system criteria are met. And chances are they will, because the stock price went up or remained above the strike price, and there's no earnings report. So we'll normally be good to go if the calculations do meet our initial time value return goal range. So we're going to evaluate 3 strikes. We're going to evaluate the $80 rolling out strike, the same strike as the near month. And then we're going to evaluate 3 rolling out and up strikes. The 85 call, so we're rolling out and up from 80 to 85, but that 85 strike is in the money compared to the current market value of 86. We're also going to look at rolling out and up to the 86 strike, which is at the money, the same as the current market value. And finally, we're going to look at rolling out and up to the 88 strike, which is out of the money compared to the current market value of the stock, which is at 86. All right, now what resources do we need to accomplish this? Well, in our calculators for covered call writing, we have a tab known as the What Now tab. And that's found in 3 of our calculators. The basic Ellman calculator, which is free on our website, in the free resources link on our web pages. The Elite calculator, which is free to premium members and available in the Blue Collar Investor store. And then we have our latest and I think our best calculator, the Elite Plus calculator, which can be used for both covered call writing and selling cash secured puts, and gives individual trade results as well as total portfolio positioning. Now, we also must be able to access an option chain, which is a price list of option prices for a particular stock. And every broker platform will have this, and there are also some terrific free sites like cboe.com that will give you this option chain pricing information. All right, let's start out with rolling out from, let's say, the October in the money 80 call to the next month's, the September 80 call to the October 80 call. 1 month expirations. So in this hypothetical, we're going to say the cost to close, as we said before, was $6.05, $6 of intrinsic value, 5 cents of time value. And let's say the 80 next month's strike was $7 in premium. Okay, so the stock price is 86. The 80 call is $6 in the money, $1 of time value profit. Now that represents, if we put that in the spreadsheet, in the blue cells, the white cells on the right side of the spreadsheet lets us know that we have a 1.19% initial time value profit, and that has 7% of downside protection. So what that means is we are guaranteed a 1.19% 1 month return as long as share value does not decline by more than 7% by expiration. Stated differently, does not drop from 86 to below 80 by expiration. So if this return meets your particular goal, then you may want to roll out to that in the money 80 strike. Let's explore next rolling out and up to the 85 in the money strike. It's still lower than current market value of 86. Now, in this particular case, let's assume for a moment that we're rolling out to this 85 strike, which generated $3 now in time value. Okay, of that $3, we know $1 is intrinsic value, the amount the 85 strike is in the money or lower than current market value. So there's $2 of time value. You don't have to worry about this. The calculator will do all the calculations for us and will let us know that we have a 2.44% initial time value profit with a 1.2% downside protection. So we're guaranteed a 2.44% 1 month return as long as share value does not decline from 86 to below the 85 strike. Okay, moving on now to the rolling out and up to the 86 at the money strike, the same exact as the current market value. Now, in this hypothetical, we're going to generate $2.50 of initial time value profit. And that represents a 3.06% initial time value return. Now, there's no downside protection. There's always a break even. And the break even is the stock price minus the total premium. Okay, we have one last strike to explore now, and that's the out of the money 88 strike. So remember, we're rolling out from the September 80 call and to the next month's October 88 out of the money call. It's $2 out of the money compared to the current market value of 86. And let's assume a premium here of $1.50. That would then represent a 1.81% initial time value profit. But there's more, because in this case, because it's an out of the money strike, we have an opportunity to generate an additional $2 per share from share appreciation if the stock price moves from 86 up to or beyond the 88 now out of the money strike. If it does, we now will have generated a 1 month return of 4.31%. So we would tend to use this out of the money 88 strike rolling out and up if we're very bullish on the market and in the stock in general, right? If we wanted to be more defensive and wanted more downside protection and we were happy with a 1.19% 1 month return, we would simply roll out to the same $80 strike. And then, of course, we have the other two choices as well, the 85 and the 86. So a lot depends on your personal risk tolerance, what your time value return goal range is, how you evaluate the overall market at that point in time, bullish, bearish, consolidating, and what the chart technicals look like. Since we're rolling an in the money strike, probably looks pretty decent. But those are the factors that we incorporate into our decision. So let me summarize, folks. Rolling options apply to in the money strikes on shares that meet our system criteria and goal. Okay, doesn't mean we automatically roll all our in the money strikes out. We may want to move away from that particular security. Most common reason are upcoming earnings reports. We use the What Now tab of the BCI calculators. I listed that for you before. And when you're rolling out, you always roll out to an in the money strike. When you roll out and up, it could be to an in the money, at the money, or out of the money strike. Now, for those of you who do not have a copy of the basic Ellman calculator, it's free. Just go to the website, www.thebluecollarinvestor.com, and look for the free resources, including Ellman calculator link on the top black bar of our web pages, and you can download the calculator right to your device. You just have to put in your email address. There are many other free resources there, including a single column put calculator in many files. Now, in our bluecollarinvestor.com/store, we have a multiplicity of online video lessons with downloadable workbooks. Our books themselves are available in ebook format, softcover, and a couple of them are available in hardcover format as well. And the calculators that I alluded to before, the more advanced calculators, including that Elite Plus calculator, which I believe is our best calculator to date, also can be accessed from the bluecollarinvestor.com store. We also have a trade planner and online mentoring programs available as well. So, ladies and gentlemen, there you have it, our BCI podcast, number 72, Rolling Covered Call Options on Expiration Friday. We have a multiplicity of choices. I hope this podcast provided some clarity as to how to make our rolling decisions on Expiration Friday. So I hope you enjoyed it. And more importantly, I hope it put some cash in your pockets. As always, this is Ellman, the Blue Collar Investor. Take care, everybody.